Welcome back everyone, and today the markets are starting off very strongly. We're seeing a lot of green across the board. In particular, semiconductors looking very nice, and you may be able to see advanced micro devices, an incredibly rare sign, up nearly 10%, significantly more than the likes of Nvidia and others in the industry. Now, this could be a sign that the market believes the tensions between both Israel and Iran are going to start to cool down, and we even have possible negotiations on the card, which will help the market with the volatility that we were expecting but actually have not been getting. And it does highlight the strength of the market that we're in now. Even with a potential new war breaking out in the Middle East, investors still sitting in greed, still believing there are many opportunities in the market. Yet one thing that could really change where we end up towards the end of the week is that on Wednesday we will be hearing from the Fed and Jerome Powell, but the majority of the market has already priced in that they are going to be holding, and that isn't something that neither Donald Trump or the US want to see. But expectations are that the first cut will come in September, and Donald Trump has spoken many times about how much he really does not like Jerome Powell. In a tweet just a few weeks ago, he called him a fool who doesn't have any clue and effectively called him Mr. Too Late Jerome Powell. Now, if you'd asked investors during Liberation Day whether they thought after the 20% drop we had in the market that we would be back to all-time highs before the halfway mark of 2025, many investors would probably not have felt confident, but that is where we are sitting today. Many of them, in fact, starting to question whether or not we should continue to buy as the market continues the upward trajectory that we saw at the beginning of the year. And Tom Lee, analyst on CNBC, very popular, he believes that one of the golden opportunities in the market is currently the small and mid-cap washed out stocks. Now, he does break out what defines a washed out stock, but some examples include Walgreens, SoFi, and Crocs, which is one we covered on the episode yesterday. He also sent a note out breaking down why he believes the upside will continue, and actually highlighted amongst the washed out stocks the Mag 7 and Bitcoin as an area that he would say is one to continue to add. And we have some other important news. If you remember, this year some of the Mag 7 had their expectations of the CapEx expenditure, with Amazon being the highest at 100 billion, where they did believe this was a once in a lifetime opportunity. And we've just heard earlier today that they are planning to invest nearly $13 billion in Australia with data centers, which is in fact the largest investment from a global tech company. So very bullish, not only on Amazon, but also artificial intelligence. And as we are seeing the market go higher today, Amazon, one of those companies, up nearly 2%. There's also some bullish news if you are a Meta shareholder, maybe not if you are someone that uses their platforms, whether that's WhatsApp or any others, as they are looking to introduce adverts into their apps. Now, we can see where exactly they are looking to add them for those that are interested. When you go into the updates and you take a look, they will be featuring some advertisements, and that is fairly bullish for shareholders. It means they will be able to capture some extra revenue, and that has got shareholders very excited. We can see up 3% on the day. Now, continuing with the theme of Mag 7, probably something that went under the radar, and arguably for good reason, is that Apple, when they had their latest worldwide developers event, it was nothing really that captured investors by excitement, even those who use their products. We have here some plans to release language translation tools, as well as a broader software design. Nothing really in terms of some exciting growth catalysts, and it's even noted here that the AI upgrades are still delayed. Now, maybe one of the largest talked about things that we got last week, where there will be changes to the overall design. Liquid glass was one of those, and we can see here from this article a very wild change. Note the sarcasm, and things are, as they say, a lot shinier. So you're probably not surprised to see while the rest of the market is up a few percentage points, Apple is pretty much flat, one that is down 8% over the last year, also trading near their 52-week low, and that their growth does look very poor at a D. In fact, they're anticipating to grow over the next 12 months in line with inflation. Now, all of this information is very important because today we do want to cover both stocks that we believe are of good value to buy, as well as stocks that we don't believe are going to give you a lot of opportunity opportunity, at least in the shorter term. And when you factor in growth, something very important, because some companies can be trading at very high valuations, but also warranted given their growth rates. On a PEG, price to earnings growth basis, many companies looking overvalued, ones that we wouldn't touch even if they dropped double digit, but you can see some that actually are looking like opportunity, and that is what we will cover today, giving you our thoughts. But even though the market looks to be overvalued, it doesn't necessarily mean that we should be anticipating a drop tomorrow, next week, next month. The saying goes, the market can remain irrational longer than you can remain solvent, but it is something worth highlighting. There is still trillions of dollars waiting to be put in the market. But also we have to be cautious, as we've highlighted before on the channel. The market S&P is trading at a forward P of 28.29, and whilst a lot of this is driven by the Mag 7 trading in the 30s and above, definitely something you should incorporate into your own thesis. And finally, before we get into the stocks, also worth highlighting, nothing has come out concrete just yet in terms of the US and China trade talks, with one of the most important parts being unresolved, that is the use of the rare earth minerals. So again, do perhaps expect potential volatility if we don't get some good news, not just on the China trade deals, but as well as many others. Now, we also want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of June. Lots of information for each one, the upside that Wall Street themselves see over the next year, as well as a recently released copy of 19 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now, the first company to buy today is Google, one which when you hear that name you typically think of search, but Google today is a tech powerhouse, is reshaping the future of AI, cloud as well as hardware, and after their latest event it's clearer than ever that Google is playing to win. Now, Sundar Pichai and the team went all in on AI at the event, where they unveiled Gemini 2.5 Pro, now integrated across search, Gmail as well as Docs, making everyday productivity smarter than ever, and this also powering a completely reimagined Android experience with on-device AI that works offline as well and protects your data. But the biggest headline out of all of this is that they're embedding Gemini into search itself, calling it the Search Generative Experience, a bold move that could completely redefine how billions of people interact with the internet, as well as launching Project Astra, Google's vision of a real-time AI assistant with video and voice understanding, capable of helping you live, not just search. And for investors, the AI momentum is already flowing into Google Cloud and ad products, both of which are seeing some very strong growth. Now, the company today is pretty much flat, the same to be said over the last 12 months, and year to date this is down around 8%. Now, as of their 52-week range, they're pretty much sitting bang in the middle, with both Wall Street and Seeking Alpha calling this company a buy. In fact, Wall Street 4.41, not far off the 4.5 to flip this into a strong buy. And just after their latest event as well, we have many analysts who did in fact reiterate their price target. The majority call the company a buy, and they see in the near term for it to hit around the $200 mark. We also have JP Morgan, who believe 195 is probably where this company should sit intrinsically, and another analyst who believe it will outperform, again highlighting the $200 mark. Now, continuing the valuation theme, we also notice it looking to be undervalued with the forward P of 19, below the 5-year rolling of 22, so that does look like potential opportunity. And if we were to take a look at this blue tunnel methodology, again it does highlight within the bounds the fair intrinsic value, that it sits below even the bottom end, again undervaluation. However, it is worth highlighting that when we do zoom out to over the last 5 years, it is very difficult to really see this company ever trading above the intrinsic price in terms of severe overvaluation, you would have to go to around 4 years ago. Otherwise, and again, might be interesting to note, might not be, but this is one that does typically, for a very long time, trade around the reasonable to even undervalued levels. Having said that though, when we look at the most recent quarter, Q1 2025, it was the fourth most bought stock by super investors, and whilst we notice this one ticker symbol here, the other one, remember the difference purely the voting rights, was also a buy by many super investors. 5 in fact from this one, we get 8 from here, so that does in combination take it to second place. And if we were to look in fact at the last 2 quarters, so also including Q4, we get the same conclusion pretty much. Google is one of those that super investors have continued to buy quarter on quarter, and if we were to just look at their portfolio in isolation, it is in fact the second and third most held stock by all super investors. Now we'll also flag institutions hold around 40% ownership, where they've sold around 52 billion in just the last 12 months. However, in the same period they've bought pretty much twice as much, as well as the same to be noted in Q1. Institutions as well as super investors very bullish on this company, and if you want to see the reverse of the trend, where in fact by a substantial distance they were selling more than buying, you would have to go to Q2 of 2023. We can also point out, for those that like to zoom out and look at the longer term, over the last 10 years, this one has massively outperformed the S&P, where they're up 540%. In comparison, S&P up 188, and they are quite continually growing their top line at a double-digit rate. It was 13% last full year, expected 12% moving forwards, and we can see significantly above the low single digit of the sector, although they're growing at a slightly slower rate than over the last 5 years. It is also worth noting the earnings per share is expected to continue growth at double-digit 15% over the next 3 to 5 years. That's above the sector median, but a little bit below their own historical. They also have an A+ on their profitability, margins very strong at 59%, not only above the sector at 53%, but showing efficiencies given over the last 5 years, it's sat lower at 56%. Bottom line also looking strong at 31%, well above the sector at 4%. Again, efficiencies well above their 5-year of 25%, whilst also generating a lot of cash from operations at 133 billion. Sector significantly lower, but still they're increasing their cash generated given the last 5 years, again a lot lower at 92 billion. Now, not only have they been increasing their revenue at a very attractive rate, 75 billion 10 years ago, now sitting at 350, they have broken a record. In fact, they are the only company to have reported a bottom line of 100 billion, something we saw in December 2024. Likewise, with their top line revenue, bottom line has been increasing in the same direction, which is always great to see and not something that you would believe is very consistent among companies. And finally, it is worth highlighting that over the next 4 quarters, they anticipate 3 of them to be growth, 100% track record. They've outperformed against analysts 4v4, and we notice most recent one, substantial outperformance by 80 cents, trading based on earnings per share for the next full year at a forward P of 17.2. Now we'll also reflect on where we see this company intrinsically, and pretty much in line with the majority of analysts, around $200 as we highlighted earlier, and that is pretty much the average, where they note 14% upside into 2026. We will reflect on how we got to this so you have a better understanding, but with their free cash flow growth year on year averaging around 20%, forward looking we've estimated around 10%. Bear in mind we have a low, medium and high, 8, 10, 12 respectively, and as always numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Google or any others, but based on the growth rate and the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to $200, indicating 14% upside. Full transparency, and very important to show as well, at 8%, we pretty much see this around the market price, highlighting already baked into the numbers moving forwards is 8% growth to the future free cash flow. If you believe it should be lower, then you will in fact be seeing this as severely overvalued. If you believe 8% to be correct, you'll see this as reasonably valued, and for those that believe it should be a lot higher at 12, well, 229 indicating 31% upside. Now, as typical on the channel, we do take through the median rate where we want to reflect on the margin of safety we see today. At 10%, it would be a buy at $180, and we usually execute on this if it meets our 3 golden criteria. That is a wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at 180, but when we keep going till it's near the current trading price, you can pretty much see Alphabet, in our view, sitting around a 10 to 15% MOS. Will be interesting to see what you believe is sufficient for the company. Do you believe this is also a buy now? For those that are interested, at 20%, buy at 160, at 25, 150, but as we highlighted, sitting around 10 to 15, with Wall Street 14% upside expected. As always though, do give us your thoughts. We then move on to the company to sell, where we have Starbucks, which has long been seen as one of the most consistent consumer stocks out there, a premium brand, global footprint, and a strong dividend. But right now, well, the coffee giant is in hot water. Sales in China, one of its most critical growth markets, are falling and fast. Last quarter, same-store sales plunged double-digit. Traffic is still down. Local competitors are aggressively undercutting on price, and consumer spending just isn't rebounding like they had hoped. Now, the company also recently announced is looking to divest from some underperforming international operations to streamline the business and refocus on profitability. Whilst in the US, foot traffic is slowing, costs are rising, and the loyalty engagement program is dipping. Not particularly a great combination. We even had Howard Schultz come out of retirement to say Starbucks has lost its focus and they need to rediscover what made them special in the first place. Now, the company pretty much flat on the day is up 15% over the last year. Year to date up 2%. Over the last 10, they're up only 70%. That is a massive underperformance of the S&P. And we notice it is trading around the mid to low end of the 52-week, whilst only one buy rating, very weak as well from Wall Street at 3.64, where 3.5 is the minimum to have this as a buy. Other two we can note into the 2s. Also worth highlighting, in their most recent quarter, we can see their revenue is up 3% year on year, slightly below inflation, where North American sales were down 1%, down 2% in the US, and we also notice massive drops to their margin, 450 basis points to their operating, and a 38% drop to their earnings per share. Yet we have noticed, perhaps maybe not the best strategy, but their global store count increasing, up 5% year on year. And as we highlighted, they are having issues in China, and they are now expected to start to lower some of their prices, with competition being a factor. Even with a price target increase just today from UBS to $95, there is still incredibly minimal upside. We're talking in low single digit, and we even notice another analyst cutting it down to around the 90 mark, so really showing, as we will come to highlight in our valuation, the upside is minimal, and with that, the margin of safety is a bit of a worry. Now, we have the forward PE sitting at 35.4, 5-year average of 28.8 does signal severe overvaluation. However, on offer is a yield of 2.6%, which is above their historical at 2.2, and maybe no surprises given what we just saw. We do get that severe overvaluation, as well as the expected price decreasing over time. Not something you want to see, so definitely something concerning. And if we were to zoom out over the last 5 years, we actually see the intrinsic price go up and down. You really want to note consistent increases over the longer term. This is a sign of a struggling company. Perhaps we will see it go back in the upwards trajectory, but on top of that, the fact that it isn't and we're getting overvalued is definitely a red flag. Now, institutions hold around 72% ownership, where they sold 10 billion in just the last 12 months. They did, however, buy around 60% more at 16 billion, whilst also buying twice as much in the most recent quarter. If you want to see the reversal of the trend, we do note in Q2, although very marginally, you'd have to go all the way to Q3 of 2023. Now, their growth also very disappointing at a D-. Year on year, we're talking flat, forward looking, not even in line with inflation, but this just highlights the sector overall isn't in a very good space at the moment, and over the last 5 years, they were growing near the double-digit rate. In terms of EPS, not looking good either, 8.2%, sector at 10.5%, and their own 5-year a lot higher at 14.3%. Yet their profitability is good at an A+, but doesn't really warrant much if they can't continue to increase their revenue. Gross profit, in fact, 25%, lower than the sector at 38%, lower than their 5-year at 26%. Bottom line, 8.6%, yes, above the sector at 4%, but we do note over the last 5 years it was high, so not really sure if an A+ is warranted, as their margins are going the wrong way. Cash from operations, though, that is up 5.5 billion, 5 years sitting a little lower at 4.8. And finally, over the next 4 quarters, they do anticipate 2 of them to be growth, however the next 2 to be a double-digit decrease, with over the last 4 years giving them a 50% track record. Most recent quarter, 7% miss. September 26, forward P still very, very high, sitting at 30.9. And our intrinsic value at $82, purely the average of the 3 models you see on screen, does indicate to us we see this trading at a premium. As we highlighted, even with the upgrades, average price target $94, meaning only 1% indicated over the next year. And as you know by now, $82, given it is lower, means no margin of safety. If you wanted to see though, at 10%, buy at $74, at 15 around $70, at 20 around $66, and at 25 around the $61 mark. Now for us, this isn't really one we would consider until it does, if it does in fact get into the 60s, but for those that do want to buy this company, we would say it looks to be trading at a fairly large premium. Give us your thoughts, maybe you agree, maybe in fact you disagree, we'd love to hear. The next stock to buy is MSCI, and if you're an investor, you've probably used them, even if you didn't know it. Now they are the backbone of global investing. Their indexes, like the MSCI World or MSCI Emerging Markets, help trillions in assets flow across markets, and their tools for ESG ratings, risk analytics, and factor investing are embedded into portfolios right across Wall Street. Now lately they have been under pressure. They are facing slower growth in some of the ESG demand, especially in Europe where new regulations are tightening about how data is used, and as interest rates do stay higher for longer, asset managers aren't launching as many new funds, which is ultimately hitting their indexing revenue, but this in fact could all change. The company is up around 13% over the last year. Year to date, they're down nearly 9%, and we do note they are trading around the mid to lower end of the 52-week range, with a double buy from Wall Street and Seeking Alpha fairly strong around the 4 mark. However, we do get a very rare sell from Quant, and we do have analysts who believe that the company will outperform, where they see this intrinsically valued around the 675 mark. And we also get a double severe undervaluation signal. The forward P of 32 does sit below the 5-year of 39, as well as giving shareholders a yield of 1.3 above the historical 1%. And this is also reconfirmed in terms of that severe undervaluation, where disparity is noted from the bottom of the blue end and where the company sits. In fact, for the majority of the last 12 months, the company has been sitting in an undervaluation space. However, if we were to zoom out over the last 5 years, it's pretty much spent equal time in each region, a few years in severe undervaluation, a few in the reasonable area, and a few, as we note, from around 2020 to 22, where it was trading severely overvalued. Now, institutions hold around 90% ownership, where they've sold around 6 billion. In contrary, though, they've bought more at 8.3, where we also notice more buying in Q1, more buying in Q4. In fact, you'd have to go to Q1 2024 to see the reversal of the trend. And it is also one that has massively outperformed the S&P over the last 10 years, up 856% to the S&P's 188. And their growth also looks fairly decent. They grew last year 12%, expected 10% over the next 12 months, which is above the mid-single digit of the sector and not that far off how they have grown on a historical level. In terms of earnings per share, pretty much expected to grow around 10%, in line with the sector, but we can see they were growing faster over the last 5 at 14. Now, profitability, they do get an A. Gross margin very high at 82%. That is just an indicator of pure isolation against the sector above, which is 60, pretty much in line with their historicals at 82. And the bottom line, 39%, that is a phenomenal margin, one of the best industries we have seen for high margins, a lot better as well than the sector at 22, and marginally higher than the 5-year at 38. They also generate 1.5 billion cash from operation, median a lot lower at 156 million, and they've also been generating a lot more, about 45%, than they have done historically. Also, we love to see green right across the board. Also note, out of the next 4 quarters, 3 of them they expect to be double digit, trading on 26 numbers with an EPS just under the $19 mark at 28.9. Now, our intrinsic value at $709 is derived using a growth rate of 14% moving forwards. However, if you're someone that believes that is high and wants to be conservative at 12, even though the most recent year sat at 21%, in fact 23 growth was 12%, prior to that looking very strong, very consistently, so we do believe this is a bit unfair on the company. Regardless, still highlighted here, undervaluation, upside of 11%. Now, taking through the 14%, there is a very nice margin of safety. At 10%, a buy at 638, at 20 around 567. Right now, you're not getting 25% just yet, sitting somewhere between 20 to 25. Wall Street themselves, as we saw with the buy rating, on average, their price target 650, 18% upside. Now, we'll also show you, if we do take a look at this, for those that want to see and want to be extremely conservative, at the 12%, you are pretty much getting a 10% margin of safety, making it, in our opinion, a very strong consideration for a high quality company in the portfolio. But again, let us know your thoughts. We then move on the company to sell, which is Nike, which has historically been a juggernaut in global retail for decades, a brand that's dominated in innovation, marketing, as well as cultural relevance. But lately, the swoosh has lost some of its momentum. The stock's been lagging the market. Recent earnings have in fact shown why. Sales in China, once a major growth engine, continue to disappoint, and consumer demand remains soft, and local brands are gaining some serious market share. At the same time, Nike is sitting on elevated inventory levels, especially in North America, which is pressurizing their margins, and the company's been forced to rely heavily on discounting to move product, not exactly what you'd expect from a premium brand, whilst they're also in the middle of a major digital transformation, cutting back wholesale distribution, pushing more direct to consumer, but that shift ultimately takes time, and investors are questioning whether the growth narrative is still intact. Now, unlike MSCI, which we believe is a buy or at least a consideration, Nike has in fact severely underperformed the S&P, up only 27%. That includes dividends reinvested over the last 10 years, when the S&P is up 188, and it was months ago where they posted their worst revenue fall, in fact, in 5 years, what they put down to very weak demand, and the company's been battered down 35% over the last year, year to date down 18%, and we are noticing it trading near their 52-week low with just one buy rating, again very weak from Wall Street at 3.7, and we can see UPS maintaining their stance on the company, weak sales trend, giving it a $56 intrinsic value as well as price target, and maybe a bit comical, but we do see RBC Capital cutting their price target by $1 down to 66, reinforcing the nature that the company does have limited upside. Now, on a forward P, sitting at 37.6, well above the 5-year of 33, severe overvaluation, yet the yield tells a different story, 2.6 on offer when the 5 years at 1.1, and we get that overvaluation signal here. Not only has the blue tunnel been decreasing, a bit of a red flag, but it sits above the upper end, again not something we want to see and some cause for concern. Now, if we zoom out to over the last 5 years, we can see a bit of a roller coaster ride. There were periods where it was trading at severe undervaluation, but if you had bought at these points, very interesting to note, you would be down right now significantly. That is because the fair value of the company has been decreasing. Definitely not any position an investor wants to be in. And institutions with their 64% ownership sold around $9 billion over the last year, buying nearly twice as much at $15 billion, and very bullish in the most recent quarter, buying a lot than they have been selling. So they have, at least in the recent times, been very bullish. Now, their growth is absolutely incredible for the wrong reasons at an F. Decrease of 7% year on year, expected negative 4% moving forwards. Sector, whilst very poor, still positive nonetheless, and this is a company that historically has been increasing at the mid-single digit rate, with EPS projected not even 1% growth over the next 3 to 5 years, when the sector and the 5-year comes in higher at 11 to 13%. Now, profitability does come in at an A+, with their gross margin at 44%, above the sector at 38%, pretty much in line thereabouts with the 5-year. Bottom line, 9 to 10% above the sector again, little bit lower than their 5-year, with cash from operations 5.9 billion, not far off their historical 5.5, but significantly higher than the sector's 290 million. And finally, earnings over the next 4 quarters, only one of them growth, the next 3 large double-digit decreases, 100% track record, but a bit of an alarming sign here is that the EPS is anticipated to decrease over the next full accounting period, actually increasing the forward P to the 30 mark. Now, our intrinsic value gets to $73, the average of the 3, which, remember, as always, you can grab a copy of by clicking on the pinned comment below, running through your own numbers, whether it's for this company or any others, but we actually do get to see a margin of safety based on the current price. At 10%, a buy at 66, at 15, that is where we see the company now. Look, we have gone through this company. There are a lot of issues with it. That is why we don't believe that a 15% is even sufficient. If you wanted 20%, a buy at 59, at 25, around 55, and at 30, around the lower end of the 50 mark is probably where you could consider, but really only if you believe the company will be able to rebound. They have a lot of inventory. They are doing a lot of discounts, which is hurting their premium brand, but perhaps you believe they can turn around and over the next 5 to 10 years get back to being where they once were. But in conclusion, as we said, 15% MOS, Wall Street themselves, $75 price target over the next year, 21% upside. Give us your thoughts, whether you agree or disagree with the choices today. And don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.